Word. So welcome everyone again. We are sharing in the chat. We're seeing a lot of news about what's happening with the economy, what's happening with banks, what's happening with interest rates. And I just want to see how it's affecting people right now, and your thoughts and reflections about what's happening, because we're going to talk about that and have some powerful information to make really good decisions in times like this. Okay. So I see you guys are dropping in the chat. Apprehensive because of retiring. Yeah, lots of fear provoking. I agree. Um, just watching what's happening. Ooh, somebody wrote that Pluto is changing from Capricorn, so was expecting this wave. I like a little astrology. Unpredictable. Scared, but grabbing it by the bull. Ooh, somebody said they're watching and trying to figure out how to get rich during this time, because this is actually the time of where the best opportunities really and truly are presenting themselves. So again, welcome everyone. My name is Alicia Holmes, aka the Wealth Whisperer. It is my passion, purpose to financially empower women. And tonight is the Investing Masterclass. I have seen people take the information from this session alone, just 2 hours, 2 to 3 hours, including the working sessions, make some decisions, and have life-changing results in ways they could not imagine. So in the interest of time, I have a lot that I have to cover. I'm going to go ahead and share my screen and get started. All right. Slideshow. Here we go. So for those of you who are in the tri-state area, particularly if you're in New York, the Black Men's Brunch is this Saturday from 10 a.m. to 2 p.m. It is sponsored by 500 Men Making a Difference in partnership with the mayor. 500 Men Making a Difference is such a powerful organization in Brooklyn. When I started out in Journey to Wealth, they were so supportive. They lent me their space for free. Just we love what you're doing for the community. They are constantly doing, in violence, access to real estate investing. They are always doing incredible information. This event, they have the folks from Earn Your Leisure. They have A.R. Bernard. They have a number of other Don Peoples and other real estate professionals. This is a really powerful event. And when I've attended their events in the past, it's also been a great opportunity to network. So I wanted to share that with you guys. It's happening in Brooklyn at the Navy Yard this Saturday. Okay. Also, on Monday, every month or every other month, I try to do an Ask Me Anything session. With all that's going on in the world right now, I really want to make sure that people have a place where they can ask their questions, so they're not making rash decisions. Things are so unpredictable. We don't know what's going to happen from 1 week to the next. So, and while you're doing your work and working on your portfolio and implementing a lot of the things that you're learning, questions come up. So this is an opportunity for you to ask me anything. And I always do maybe a 10 to 15 minute discussion. This is a very important time. For those of you who are in the boot camp, you're going to learn a lot more about this, but why right now is a very important time to buy Bitcoin. And I'm just feeling so inspired. Some of you know that a dear friend of mine, I told her about, I think it was not the end of 2021, about a school I support in Uganda and how they needed a medical center during COVID. And she immediately, I mean, weeks, checked it out and came out of her pocket and built this medical center. And then a number of us chipped in to build out a medical center. And a year later, they have a full medical center in a rural community where like there's literally no access to healthcare for hours and miles away. And so what we thought was going to be for the school is actually for the community. And so, when we take care of this area of our lives, we can take care of and impact the things that are really important to us. So this weekend, this particular girlfriend of mine started her foundation, High Tide, and she's doing amazing work all over the world. And I want to give you a little perspective of what it looks like when you have these areas handled. So someone said, I have access to solar power and I can get solar power installed there. But the people who are donating solar power are doing it around maternal health. And so they were like, it would be great. So one of the things we learned while we were there is that, riding a bus is expensive. So everyone rides scooters. So women who are about to give birth on these bumpy roads on these tiny scooters and trying to ride for 3 to 5 hours in order to deliver their babies. And many babies are born on the road. So they wanted to create a maternity ward. And someone there said, you know what? I'll build out the maternity ward. And there's someone else who was like, I can get the solar panels put in so they can have full power and energy. So I tell you this story because I know that there are things in the world that are really important to all of us. And this is not just about building wealth. This is also about having an impact on things in the world that are really, really important to us. So this is from me, our own personal financial and time freedom is necessary in order to powerfully impact the people and causes that are near and dear to our hearts. So this is also why we are doing the work that we're doing right now. So putting it in context. So I'm going to ask everyone to choose a location with little background noise. Invite members of your household to avoid disturbing you. Please have your camera on. It's so easy to get distracted when it comes to numbers, particularly for us as women, or maybe even check out. But let's make sure we're all checked in. And let's have our cameras on and be full participants. Say your name before speaking and make sure your name is displayed. Mute your phone or computer when you're not speaking. If you need to take a moment to do that now, please do. Type questions into the chat box and share at the appropriate times. And then if you could locate your mute, chat, and hand raising, I'll ask you to raise your hands, I'm sure, many times in this presentation. And you are absolutely and totally welcome to take screenshots of the slides that I'm presenting. Okay, so we'll be talking about investing today. So I want to start with my disclaimer. Trading stocks, crypto, and any other securities involves risk. The risk of loss in trading securities can be substantial. The risks involved with trading stocks and other securities are not suitable for all investors. The information presented in this educational material is not intended to be used as the sole basis of any investment decisions, nor should it be construed as advice designed to meet the investment needs of any particular investor. Nothing in this constitutes legal, accounting, or tax advice or individually tailored investment advice. All right. Okay. So when women are strong financially, we all win. Welcome to the Investing Masterclass. There will also be a working session. I'll talk more about that on March 25th from 9 a.m. to 10 a.m. EST. And I'm going to jump right in. So some ground rules. Noticing and avoiding negative self-talk. I think they said there's 70K messages or words or things that we say to ourselves daily. Mostly those things are things we've said to ourselves in the past. And in the area of money specifically, They're often negative. So a lot of the time it's just happening behind the scene. And unless you're intentional about paying attention to it, you're not paying attention to what you're actually saying to yourself. So I want you to really notice what you're saying to yourself as we go through this conversation about investing and what you should know and what you can do when it comes to investing. Pay attention again to what you're saying to yourself. Our self-talk is incredibly and powerful because our words actually create our worlds and everything we have. We're always creating our worlds. We're always manifesting our worlds. It's the things we want to take credit for and the things that we don't. So we're in the habit in the Journey to Wealth community of affirming ourselves and saying, I receive that. When there's anything positive presented, affirm yourself in the today. You know, if you're saying, you know what, I have been dollar cost averaging and I've been doing it for decades, affirm it. And you may say, in the past, I wasn't putting them in the most opportune assets, maybe, but I affirmed that I was dollar cost averaging. And the things that we are no longer going to have be present for us, we put them in the past and say in the past. I really and truly ask you to listen from what you can discover for yourself. Be an empty cup, because very often we are not getting the specialized knowledge about what it means to be powerful investors as women. And always, as always, again, type in the chat. I do it my networks. Okay. So I explained to everyone that I have a passion for serving Black and all women, but specifically Black and Latina and Latino families. And that's because all of the stats are showing that if the racial wealth divide is not addressed, is currently in a state of emergency, we're on a path to hit zero. You notice I'm using wealth. This is not income. We all know our incomes could go up and up and up, but that does not necessarily mean that we are building wealth. Many of you attended my Seducing Abundance Challenge or other talks that I've given. And wealth in our culture and capitalist society is measured by net worth. That's when you take everything you own, all your assets, subtract your liabilities, and that bottom line is your net worth. And the only way to really be in the wealth building game, to have wealth accumulating for you, your family, and future generations and impact over time, is actually to be in the net worth game. And that's the wealth game. So I have to share these startling statistics. So there was a study by the Federal Reserve of Boston that looked at white, Black, and Latino families. And they looked at wealth. So they found that for white families, the median wealth was about $250,000. For Puerto Rican families, it was around $3,000, Dominican, $1,700. And for Black families, it was $8. And so the work that I am committed to doing in the world is to disrupt this wealth gap. And then there's an investment gap. That's another cause of the wealth divide. So the investment gaps is costing all women millions of dollars over their lifetime. Women make up only 8% of investors. Only 0.05% of women have invested in startups, and only 6% of Bitcoin investors are female. I want us to let these statistics sink in. Women business owners are woefully behind their male counterparts when it comes to investing and retirement preparation. And while we have similar cash and debt balances, men have more than double the investment account balances, leading to a much higher net worth. So there's a study, lifting as we climb, if anyone wants to look it up. And in 2013, the study showed that white women between like 36 and 49, which is when every group had their highest net worth, had a net worth around 42,600. That was still only 61% of the median wealth for men of the same age. While women of color, Black and Latina women in the same group had a median wealth of just $5. Now, the study was recently, they redid the study recently. Let me move this out of the way. And in 2019, and the statistics are just coming out, for women of color, for Latina women, it went to $1,000. And for Black women, it went to $1,700. For white women, it actually went to $81,200. Now, I'm giving you these statistics to show that there really is a state of emergency. And we really have to have the right information so that we can address this wealth gap. So if anyone wants to type into the chat any kind of reflections on this, please take a moment to do that now. Okay, so I have a lot to cover, so I'm going to keep it moving, ladies. Okay. All right. So how do we, so our current paradigm is that we exchange our time for income. So the conversation around investing, and I didn't share my story about having someone taking me under their wing when I was just 19. And the question they asked me is, do you want to be rich or wealthy? And I didn't know what the difference was. And they said, if you're rich, you have money, and you're wealthy, you have your time. I learned that the current paradigm is you exchange your time for income. So if you did not exchange your time for income, what would happen? For many of us, we don't even have a vision. So the paradigm shift for me was to make the kind of decisions where I did not have to exchange my time for income. So I want everyone to know that you do not have to exchange your time for income. That's what people call quote unquote retirement, that you can increase and replace your income without increasing your working hours. And it's easier than you think with the right information. And this is what we're talking about today. We're talking about how we turn our income into wealth so that we don't have to exchange our time for income. And we do that by becoming investors. Now, by a show of hand, how many of you are currently investing? Those electronic hands, if you can. So if you have a retirement account, you are investing because your money is going into accounts so that it can grow. So I should see, and if you don't have a retirement account, you're going to learn some quick, easy ways to set one up as soon as possible if you have any earned income. Okay, so I want to talk about where we are right now. And I love this, the cycle of market emotions. So this line graph here represents what they call price action. So every point on this line is representing the price of some asset moving up, the price moving up, and the price moving down. So where are we right now in the cycle of market emotions? Are we at the highs up here, or are we at the lows? Yes. So let's talk about this a little bit. So when there's optimism, excitement, thrill, euphoria, you're actually at the point of maximum risk. Then there comes the falling prices, anxiety, denial, fear, desperation, panic, despondency, and depression. This point in the market cycle is where you have your maximum opportunity. This is why I am so intentional this year about speaking as much as I can, reaching out as much as I can, because this is what they call the wealth building cycle. This is where the largest transfers of wealth happen. The decisions you make at times like this can last for generations to come. This is when you plant the investing seeds. If this resonates with anyone, please raise your hand. This is the time. So let's talk about, and I'm going to give you guys a chance to weigh in on your thoughts about what I'm sharing right now, because sometimes it's counterintuitive. What's happening? We're in a markets go in cycles. They go up and down and up and down and up and down. We know it's cyclical. And there's some patterns in these cycles. So we're in a very interesting cycle right now because we're in the beginning of an industrial revolution. We got AI and quantum computing and all these things happening. There's a future of work and a future of money that's shifting and changing. We have high inflation, rising interest rates, political uncertainty. So I'm going to wait till the end because I really want to get through the material to talk about what's happening with the banking industry. We have monetary policy impacting productivity and consumer confidence. We have a debt ceiling. So just so you know, for every dollar in revenue that this government brings in, they spend $2. And how do they get to spend $2 if they don't only have $1? Where's that other dollar coming from? Debt, the selling of treasury bonds. For those of you who are New Yorkers, there's the debt calculator on 6th Avenue, and it's going up and up and up. I think it's at $31 trillion right now. There's something called the X date. That's the date where can you continue to operate and at the same time continue to overspend? And Congress keeps raising this debt ceiling. Let's just take on more debt. Let's just take on more debt. And when they're not taking on more debt, they're actually borrowing from Social Security and federal pension plans. And so you cannot continuously do this forever. This is happening in the background. Then you have technological advancements. We're going to talk about the future of money, but the future of work. 20,000 jobs a day are lost to AI. And I just want to share some statistics. Black, brown folks, 76% of Blacks and 62%, this is the future of work. There's a huge study done in 2020, could get shut out or be underprepared for 86% of the jobs in the US by 2045. In one generation alone, digitization could render the country's minorities into an unemployment abyss. So this is some of the things happening in the background right now that we need to understand. And I could have in a boot camp, for those of you who signed up, we'll go into more depth about some of the future of work and how we really should be preparing ourselves. So what is this? All of this is happening, and it's causing so much uncertainty. And that uncertainty is causing major market swings. But remember what I said about that. That's actually huge opportunity, and there are lots of strategies. Okay, so I haven't in a little while. Well, let me just go here for a moment. Fiat is fragile. You know what fiat is? Fiat is currencies. It's the dollar, the euro, the yen. All of those currencies, an economic term for them is fiat. So we should get comfortable with that because we'll be seeing a lot more of it. All of the volatility and all of the things that I just showed you point to the fact that fiat can be the dollar in your pocket could be very fragile based upon government decisions and banking decisions. Argentina, it's a great example of this. Their currency became worthless because of their government decisions, mostly the debt decision, completely. It was in 2001, too. People were abandoning their homes and running away. Who were the only people who were safe? What did they have? Where did they store their value? If their dollar became worthless, because currency stores value. You work, the value of your work, you get a currency, you can exchange it. It's called the store of value. If the currency, if there's bad decision making by banks and governments, and the dollar becomes worthless, or anyone's currency becomes worthless, what do you use as an exchange, and what has value? I don't know if you guys are typing in the chat. Yes. So you see it right in front of you on the screen. If you don't want to be at the mercy of your government decisions or banking institutions, when fiat is fragile, precious metals have a universal value across the world. And when this happened to Argentina, the people who had precious metals were the ones who were able to survive it. So there's the article from 2019, Billionaires Only, Please. It's a London vault that's right across the street from Harrods. And they said, billionaires only, people, please. And so this is just to show you how important owning precious metal can be to people who are very wealthy, because they know that this is a store of value that they can count on. So later on in the presentation, I'm going to show you how you can actually purchase gold and silver. I was doing this in 2016 when it was much cheaper than it is now. And again, I'm providing you education. It's an asset class. And we all know that diversifying your assets is something you should always think about doing. So I'll show you the places where you actually can purchase precious metals. Okay. So before you purchase anything, I'm going to stop sharing. And I've shared a lot of information, and I want this to be interactive. If I can get some reflections on some of the information that I've shared so far. Arisha, is that your hand up? No, ladies signing on. If also you can type in the chat, how many of you were aware of gold and silver being a store of value when, oh, I see some hands going up. Okay, Melissa.
Hi, Alicia. Hi, everyone. So I, like many, have had unhealthy relationship with money, didn't understand it, didn't know how to use it, all this other stuff. The last year I've really been sort of respecting it more, because I think that's a big thing, right? I never really respected or valued money. And then when I took your I almost said the wrong word, seducing abundance. I almost said sexual abundance. Not the right word. Not the right class. I really started paying attention. Even though I was already working on my budget and working on, paying down debt and all that other stuff. What you taught in those 5 days really shifted my mindset. And just in the last, not even hour, I'm already starting to see more shifts. And so I'm super excited about the boot camp. But yeah, I really feel like at this point, we all have to really just do it, right? Just do it. Put aside our fears, put aside, apprehensions, not to address it when they come up, but be mindful of the long term versus the now, so.
Absolutely. I call it a year for planting seeds. I absolutely and totally agree. Thank you for that, Melissa. I remember seeing your face on every session, I think, in Seducing Abundance. So your face is very familiar.
I was in it.
All right, Gabriella.
Yes, thank you so much, Alicia. I'm so grateful to be here. I took your Seducing Abundance or Seducing Wealth series, and I signed up for the boot camp. So I'm looking forward to that. And I have to say I'm excited. And this last couple of weeks, I have to say my heart has been lurching up and down because I'm like, what the heck? I've started paying attention to some of the reports from my retirement fund, my 401k. And usually I would just kind of look at them and say, let the financial advisor handle that and put them in the shredder and not worry about it. But now I'm starting to look and it's like, oh my God, oh my God, oh my God, oh my God. I can't even stomach it at this, just looking at this stuff. It's like how much value it has lost. And that's frightening. And at the same time, being in a place that, okay, now I'm here to empower myself in getting back in the driver's seat, because I've not done that for so many years that it's like enough is enough. I'm 58 years old this year. And so that then is also, what's going on next, because I'm approaching my 60s. Now what,
No, I absolutely and totally love it. And I'm going to address everything that you just said there, the volatility of the market, because I'm going to show you how to assess your current investments and how to think about it in terms of the market being down right now. So thank you for that. So I'm going to go back to the presentation now. All right, so we're going to get into the heart of the fundamentals of investing. So this is what we'll be talking about: fundamentals of investing, what you can invest in, where to invest, and then how to assess your current investments. Okay, so let's start with investing. So exploring the investor mindset. There are two. You're either an investor, and what is the opposite of an investor? You can type in the chat. What's the opposite of an investor? I used to have one word, but now I think there are two. So the opposite of an investor is a consumer. So when resources are coming into our lives and they're flowing out, they're flowing into two places: places that have built other people in wealth, and that's being a consumer, or places that will build your own wealth, and that's being an investor. So I said the caveat here that I want to add a new one, also add to this, is being a saver, because saving is not investing. So a lot of women, because of all of the social conditioning, somebody's supposed to take care of this for us, and what we don't understand, very often when we do the right thing around our money, we're saving it, or we're putting it in vehicles that grow very little, that don't even beat inflation sometimes. So we're actually losing money by putting it there. So if we have to think about the dollars, those little soldiers, where are they going? Are they going to build someone else wealth? Are we investing them so they can give us options? Or are we saving them? And sometimes if you're saving and you're not meeting inflation, you're really still losing dollars. Okay, so the fundamental concepts for investing, what you need to know. Return on an investment and how to actually make sense of it. Fees, how they impact your investment decisions. And looking at benchmarks, comparing in order to determine whether or not your assets are performing well. You have to have something to compare it to. So I'm going to go into depth about these three things. When you understand these three things, you are financially empowered. Whether you want to invest for yourself or whether or not you want to manage someone who is investing for you. But without knowing these three things, you can absolutely and totally find yourself very, very vulnerable. So I'm going to start with fees. The impact of fees. Fees substantially impact your investments. The SEC, Office of Investor Education and Advocacy, put out a bulletin. They put out a bulletin because people are so ill-informed about fees, and specifically us as women, and the impact that they can have on our portfolios. So, what fee will I pay to purchase, hold, and sell this investment? Making sure those fees appear clearly so you know what they are. This has been a big deal. When you're doing this work, actually figuring out what are my fees. And it says something when it's real clear, you don't have to search for them. Are there any other transaction or advisory fees? Account fees, account inactivity, wire transfer, any other fees? And after you ask that question, you can say, is there anything we missed? Is there any other fees? It's so important to understand what fee you're paying and the impact that it's going to have on your investments. So this graph here is from the SEC's bulletin. So this is an example. So let's say in 20 years, the total amount paid for a 1% annual fee adds up to almost $28,000 for a $100,000 initial investment. In addition, if you were able to invest that $28,000 you paid in fees, you'd have an additional $12,000. So that $100,000 cost you $40K in fees on 1%. So how many of you know that 1% is a huge fee to pay on any of the investments in your portfolio? So what should you be paying? A good rule of thumb, because if 1% is actually a high fee to pay on your investments, 0.4% is actually a 0.4% is a good rule of thumb. So imagine 1% costing you 40% of that initial $100,000 investment. So I'm going to show you how to assess this and where you can get more favorable terms in the kinds of investments that are anywhere, including in your retirement portfolio. Okay, so the second thing you need to know is your return on investment. So, is your money working for you? So we're going to look at return on investment, compound interest, and we're going to look at dollar cost averaging. So let's do a little millionaire math. And there's something called compound interest. To compound interest to compound anything is to intensify it. In the financial world, there's something called a miracle of compound interest. Albert Einstein said that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So what is compound interest? Compound interest is interest added to the principal. Everybody following me? We're talking math now. We're going to do some math too. So that the added interest also earns interest from then on. This addition of interest to the principal is called compounding. It's the actual idea that you can make money on the money that you've already earned. So we're going to explain this through a document. All right, ladies, I need to see some faces to make sure you guys are not checking out on me, because we're going to do some math here. So I call this millionaire math. It is the same exact math you do when you go shopping and you get in a discount. So if you went shopping for some shoes and they were $100 and someone told you they were 10% off, you would in 2 seconds say, oh, my shoes are $90. So the same math we're using for other things, we're going to use it at what in the capacity of what I call millionaire math. So let's look at compound interest here. Okay. So I see some familiar faces, some new faces. Some of you have done this with me before. Okay, so let's look at compound interest. We're going to work the numbers. So let's say you had $1,000 only, $1,000. That's all you invested. And you had an interest rate of 10%. So the left side shows you simple interest, which we're very accustomed to. And the right side shows you compound interest. So on the left side, simple interest, you had $1,000, you get 10% is $100. At the end of the year, you have $1,100. You have $1,000 the second year, you get $200, you get $100. The end of the next year, you have $1,200. So each year, you get $100 on that $1,000, 10%, and it would just start to accumulate. So by the time 20 years have passed, you've gotten $2,000. Everyone's following me? $100 a year for 20 years. That's $2,000. And you're initially putting $100. I'm sorry, $1,000. So now you have $3,000. Everybody with me? Okay, so let's do compound interest because it's important to understand how this works. So with compound interest, remember you're getting interest on the added interest. So the first year you have $1,000, you get 10%, so you have 1,100. But that year you're going to get 10% on the entire 1,100. So 1,100 plus 10% of that is 110. So now you have 1,210 at the end of that year. The next year, you get 10% on the 1,210, which is 121. You add that to your original amount, and you have 1,331. The next year, you get 10% on 1,331. That's equal to 133.10. So the next year, you have 1,464. 1,464 plus the 10%, 146. Everyone's following me. Anyone not following me on how compound interest works? Okay, so compounding is powerful, the way that your money can grow, because it's really talking about adding a level of exponential growth here. So the same money, if you did this simple interest, $1,000, $100 a year for your 10%, at the end of 50 years, you'd have $5,000. But if you did the same thing and you compounded that money, you never put another penny in, by the end of the year, you'd have $117,000. Remember, you didn't put another penny in. All it was doing was compounding. This is the power of compound interest. So some of you saw this chart before, what it looks like when you're being consistent and you're investing and you're receiving compound interest. So this chart shows you what would happen if you invested $100 a month consistently for 5 years, 10 years, 20 years, 30 years, 40 years. And it shows you that each row shows you the interest rate that you would be receiving, or the return on interest, the return on your investment for 2%, 3%, 4%, 5%, all the way down to 12%. So if you took $100 and you invested it consistently, and you put it in something like a CD, in 40 years, you'd have $73,000. Now, if you invested it in the market, and we're going to talk about the market, that same money, you can have anywhere between 5 to 600K. Same money, but just investing it in a different vehicle that you understand. So this is how money works when this is how compound interest works for you. You don't need a lot, but you do need to be consistent. So I shared with many of you before that when I see $100 bill, let's say you want to increase your cable bill or your phone plan by $100, when you really understand compound interest, that $100 doesn't look like $100. It looks like 600K. If you learn a little more about investing and you're investing in REITs and technology and some different things, and you're getting 12% plus, that $100 a month that you're paying, I mentioned my pet peeve being storage, having things that we don't use and then paying to hold them over time, literally has really cost you or could cost someone $1 million. This is the power of internalizing and understanding compound interest, because this is why investors behave and think differently, because they know how money works and grows over time. So this paying $100 consistently over time is a strategy called dollar cost averaging. So how many of you are familiar with the dollar cost averaging strategy and how it works? Raise your hand and let me know if you're familiar with dollar cost averaging. Your electronic hand if you can. Okay, so when you understand dollar cost averaging, I didn't see a lot of hands going up, but when you understand dollar cost averaging, you don't get so freaked out when the market pulls back. And I'm going to show you numerically why. And the person who shared earlier about watching the market cycle, during all times really in bull markets and even especially in bear markets, if you understand dollar cost averaging, you'll see the complete and total advantage of markets pulling back. So I'm going to go over it numerically for you. Okay, here we go. So what is dollar cost averaging? It is investing a fixed amount monthly, regardless of the share price. It allows you to automatically buy more when prices are lower and fewer shares when prices are higher. Over time, it reduces the average cost of your shares. So let's look at what happens here. Let's say you had $100 per month that you're investing, like in the example that I just showed to you. You vetted a stock, a crypto, an ETF, or it can be the mutual fund in your retirement account. And you're purchasing that one asset with $100 a month. So in the beginning of the year, let's say the share price was $20. So you were able to buy $5, 5 shares, and your portfolio is worth $100. 5 times the $20 a share. Now, the next month, the price of the asset goes down to $18. So you're able to buy more, 5.56, but it is going down. And so if you take the $5 plus the 5 shares plus the 5.56 shares, you actually have 11.56 shares in total, and the price is $18. So you're down a little here. Your portfolio is only worth $190. The total shares you bought times the current price of the stock or crypto or asset that you purchase. Then the next month, it falls even lower. But what happens? You can buy even more shares. So now you buy 6.25. So you bought 5 shares, then 5.56, then 6.25 shares. You add that all up because that's what you bought, that's what you own. and you times it by the current price at that point, it's only $16. You paid a lot more for these shares before. So when you add these all up and you times it by the current price, 16, it's worth $269. Now remember, you spent $300. It's your third month. This continues to happen. Price goes down to 14, but now you're buying more shares. You're buying 7.14. The price goes down to 12. You're buying 8.33. And the market completely crashes and it goes down to half the price you originally bought is at $10 a share. But what happens now? You're actually buying it at $10 a share and you're getting 10 shares. Now, the way markets work is they pull back, they go up to where they previously were, they go higher, and they pull back. So the market economy that we're in, the reason why it is going upwards is because even though it pulls back, it continues to go upward. What that tells you is at some point that $20 per share is going to go back to the $20 a share that it originally was. Oh, I'm sorry. So what happens now? The market starts to recover. You're still putting your $100 a share in. And in the end, you were able to get all of these shares at a much lower price. And so when you total up all of the shares you bought and all of the months that you were able to buy more shares because it was less, and you're back to $20 per share, you actually have a gain of 33.22%. So when you understand dollar cost averaging, and this is not a short-term game, and you have a longer-term horizon, and you can look at a chart and know that it goes down and goes up, you know that when it goes down, that's a great opportunity for you because you are buying things on sale. And when it returns to the previous rate, you have all of the shares that you brought on sale. So this is why when there are major market pullbacks, one, it's a time to buy things on sale. And two, we'll see some of the largest transfers of wealth. Now, this is a zero-sum game. So at $10 a share, when people are buying, when people, the worst thing that you can do is when it drops to sell it. And so now you're selling it, you're locking in your losses. And then what people often do when they don't know, then they buy it back at a higher cost. So you've taken your money, you've sold something at a loss, and then you buy it higher. It's like a double whammy of getting hit financially by making those kinds of decisions. This is actually the time, if you didn't sell it up here, not to sell it here, buy more when it's down. And then what you want to do is wait until it recovers. And the people who do that make really strong decisions and do very well when the market pulls back. So I'm going to stop sharing for a moment and see if you guys are following me and understanding what I'm talking about with the dollar cost averaging and how purchasing consistently over time and when the market pulls back, being able to take advantage of the dips in the market, knowing that we're in a market that markets always recover. Okay. Any questions about this? If you do not understand this, we have to empower ourselves, ladies. If you have any questions, now is the time to ask. Any questions? Okay, Pam, I see you have a question.
So I followed everything. And my question is, when the market goes back up to your original purchase price of the 20, do you keep it? Do you sell it? What do you do?
So, that's a great question. So it's great to have a long-term perspective, but there is something about when you're closer to retirement, paying attention to market cycles and pay attention to where things are going. So people who were in the Journey to Wealth community, I think it was in, I'm not even sure. I think was it last year? This is 23, 22. Could have even been 2021. And there was all of these indicators that the market was going to pull back, pull back, pull back. And so, and the market was at some decent levels and highs. And so people who were close to retirement, I let them know. I said, the market could pull back. It's up to you. I'm giving you the education. You don't want to sell when it's low. If you're close to retirement, you want to pay attention to these. And so there are quite a few women in the community who are in retirement or at retirement who had to make a choice. And so some of them missed out on some future, like some swings up, but they also are, when the rest of the market is really down, really low, they still have quite a bit of, like, they didn't go through that major downward swing. So, that there's a number of factors to take into consideration. But when it already is pulled back so low, if you sell, then you're locking in your losses.
Right.
Mm-hmm. Yeah.
I understand.
Mm-hmm. Yes. All right. Any other, is that it? Yeah, that's good. Okay. Someone else I saw had a question. Tina, is that your hand? Because it looks like it's in the design of what's on your wall. Is that a hand?
I lowered it.
Uh-huh. Okay. All right. I'm going to continue. Okay. All right. So we looked at the fact that investing over time, even in small amounts consistently, gives you a great opportunities and options. And there's something called the latte factor. It's called the high cost of small spending. And we don't have time to do it tonight, but what I have people do is go in and write down, and in the boot camp, we'll go into this, write down all of the things we're spending money on a week that we don't have to spend money on. And when you're doing the spending fast, because we'll be doing a spending fast, you get real clear about it. And very often there's hundreds of dollars we're spending on things. I have challenges where we clean up, we go into our accounts and we clean up subscriptions and all those things that we haven't been spending money on. And the thing is to either to redirect those resources towards paying off debt or redirect those resources towards investing, or some combination of both. But in all the time that I have been coaching people, and it really has been decades, although my business started in 2016, there's always, when you really look at the numbers concretely, there's always more resources there than you thought. And doing a spending fast is a great way. Everyone, when you, many ladies who've been doing this with me for some time, well, after they do the spending fast, they never go back to spending the way that they were spending before. I see the heads shaking. And doing a latte factor is another way of getting at the same information. Okay, so understanding what interest rate, what return on investment are you getting on the things you're investing in? And so if this is called the rule of 72, it's a calculation that gives you the approximate number of years it's going to take you to double your money. So if you watch Bloomberg or any of the investment channels, you'll hear people in finance often talking about doubling your money. It's financial lingo. A lot of times after taking this class or boot camps, you start listening and you hear it differently. You hear everybody, you're like, wow, I never even noticed they were saying that before, and now they're saying it. So the concept of doubling your money is also like a millionaire math. It's a way of thinking. So if you take 72 and divide it by your return on your investment. It will tell you how many years it'll take you to double your money. So if this is an example, let's say you had 10K, and I have seen this play itself out in so many women's lives. You have $10,000 to invest. You put it in something you feel is safe at 3%, even close to 6%. At 3%, it's going to take you 24 years to double your money. In the 36 years you have it, you'll probably have somewhere around 23,000. Same $10,000 information. If you put it in an asset that gets you 6%, it goes from, it'll take you 12 years. 6 divided by 72, 12. So in 12 years, it'll go to 20, 24, 40, 36 years, 80. But let's say you're keeping yourself informed, you're investing in the market and the cues and the different great options you have. And you're going from, you're getting 12%. You go from 10 to 20 to 40. This is 6 years. 12% divided by 70, 72 divided by 12, it's equals 6. And so 10 to 20 to 40 to 80 to 160 to 320 to 640. So what I've said, what I'm saying I've seen many times is literally people leaving hundreds of thousands of dollars on the table by just not knowing how to evaluate their returns and some of the places that you can actually get a good return on your investment. This rule of thumb is also a good way to plan for your future. So once you start doing this work, and I'm going to show you about index funds and how they perform and the SPY and the Q and the different funds, you can say, you know what, on average, I'm getting 10%. And I know that at 10%, I'm going to double my money, let's say in 7.5 years. So if you have 100K right now, and you can say, you know what, I'm 45, when I'm 52, my 100K will be 200. By the time I'm 60, it'll be 400. By the time I am in my late 60s, it'll be 800. And so you can plan and you can actually look at how your investments are performing and what your expectations, and then you can make choices around it so that you can meet some goals. So it's powerful. Numbers are concrete. They have the right information so you can make the right choices and decisions based upon concretely based upon the kind of returns that you're expecting and the kind of investments that you're going to invest in. Okay. All right. So compound interest, I talked about how it is when it's working for you, it's a beautiful thing. When it's working for you, against you, it's like a financial cancer. Many of you attended Seducing Abundance, so you've seen this. This is an actual disclosure. I did not make this up from a credit card statement. This is credit card debt of $10,889. You pay the minimum balance due of $287. Your interest rate, your APR is 29.99. If you pay the minimum on this, how long will it take you to pay off the balance and how much will you end up paying? We don't have the time to do a lot of guessing, so I'll just show you. 74 years and $110,000. So this is an actual statement. So those shoes and bags and trips that folks are taking, literally, when you look at how much you can pay back your credit card, it's costing you the house that you wanted to have, the generational wealth. So this is the impact of credit card debt. And we do some sessions on debt elimination in the boot camp. And everyone here, I have a free debt elimination ebook. Okay, I'm gonna stop sharing again. And any reflections, any questions based upon what I've shared so far?
I have a question. Is it okay if I ask a question about the oh my God, not the dollar cost averaging before we went there, compound interest?
Yes.
Really quickly. I understand the concept, but the issue that I've been having, well, not an issue, but the question is like, how can I find 5% and up, you know?
I'm going to show you.
Okay.
That's coming next.
Okay.
Okay. All right. But that's a great question. Okay. So it's coming up right now, as a matter of fact. So we talked about the first two concepts. Most people know return on investment and fees. Now we're going to talk about one of the most important concepts, and that is benchmarks. So I gave you guys 3 videos that I highly recommend. One of them is 2 minutes, one of them is, and I think the other 2 or 3 minutes, on what is an index, what is a mutual fund, and what is an ETF. So a benchmark, anything in life, you should get in the habit of benchmarking. Benchmarking is having a standard that you can compare something against so you can evaluate it accurately. So if you wanted to know like your calorie intake, if the average calorie intake is 2,000 calories, I don't know what it is, and you're taking in 4,000, then you're like, oh my God, I'm like taking in more than double the average calories that I should be taking in. You have to have something, or if you were just looking at the 4,000, it's hard to tell. So the benchmarking is making those comparisons. So an index is an indicator or a measure of something, and they're often used as a standard for a benchmark. So there's the indexes within the stock market are some familiar ones, some that may be familiar to you, such as the S&P 500 or the Dow. What those they are indexes. So indexes serve as benchmarks to compare and evaluate your investment performance. So let's look at this S&P 500. The S&P 500 is the top 500 stocks, and they put them in an index in a certain proportion, and they come up with average performance of all of the stocks in that portfolio. The S&P 500 is 500 of them in a certain proportion. So they'll say that the S&P 500 is up 2%, down 2%. It's at 18% this year. That serves as one of the most fundamental benchmarks for the market. So now it's almost synonymous with the market. So when you say the S&P 500 is up 20%, you're saying the market is up 20%. When you say it's down 5%, you're saying the market is down %. So it serves as a benchmark. That is what indexes are for. So let's look at the S&P 500. It's the market. It's easy to follow. It's everywhere. It is an evaluation of how the market is performing. So this is the S&P 500 every year. And what you'll see here, that 73% of the years have been positive returns, and the average return has been 10%. Everyone, are you able to follow this chart? So let's look at what's happened in the 2000s or the 2022s. It's cut off a little bit, but this category here from 0 to 10%, look at how many years it's been 0 to 10%. Look at how many years it's been 10 to 20%, 20 to 30%, 30 to 40%. These are all of the years that the S&P 500 performance has been that high. And look at the years, 11, 15, 2010, 12, 14, 16, 20, 2009, 17, 21, when it was doing 20 to 30%, 30 to 40%. 2013, 2019. So we see that in the 20th century, the market has been performing pretty well. It's only performed really poorly a couple of times in the 2000s. Are we following this? So someone just asked, where can you get above 5% by investing in the market? I would say in all of the years that I have been doing this, and it's 30 plus years, if women looked at their invested in the market versus some of their current investments, they'd have hundreds of thousands of dollars more in their portfolios. And then during COVID, when I worked with 1,000 plus women, I would say close to 90% of them were in investments that were underperforming the market. But not only were they underperforming the market, they were underperforming the market and they had high fees. So it was like a double whammy. So what I'm going to show you to do today is how to evaluate your current investments so that you are taking advantage of the opportunities to invest in assets that actually grow over time. This is the low-hanging fruit. It's the market and how you can do that. So I'm going to move on before we do questions and reflections. I got a little quiz for you. So I just talked about you being able to invest in the market. So if you watch the little videos that I sent you, you'd have the answers to these. And this is, the answers to these questions will tell you how you invest in the market. So there's an investment where investors pool their money together. A fund manager invests in different assets. It generates a return, and then the return is passed back to the investor, and then that money is pooled again. So it's a cycle where there is a fund, I'm sorry, it says fund manager. I wish they were fun. A fund manager who's taking pooled money, investing in assets, and that generate return. What asset is described above? You guys want to type in the chat? Yes, I see you guys on it. You are on it, on it, on it. Yes, that is a mutual fund. And what people don't know, mutual funds are very recent. There was a time when only people who had fund managers or portfolio managers were the very, very rich. And then someone came up with the brilliant idea to say, how about we just pool a lot of people's money and not just do it for the very, very rich and create funds for the general public. And it took on a life of its own. And not only did it help, it helped the markets because there was more money flowing into markets for people to invest also. So that is a mutual fund. And now mutual funds can be active or passive. So the ladies who are in the Journey to Wealth community, is this all old hat to you, old knowledge, or are you like, oh my God, I forgot this stuff? All right, so what kind of funds are active and what kind are passive? Type in the chat if you know. And it's more important than ever. So the ladies who've in the community, it's more important than ever that you remember this information. Let me see what you got. Let me see what I have in the chat. Yes. All right. I see Swati, and she's a ringer because she she actually supports ladies in the boot camp with going through the process of assessing their portfolios in the way that I'm going to teach you today. And Swati is an incredible example. because Swati had a number of different funds and ETF things in her account. And when she took the investing masterclass, she literally went through one by one by one, assessed them, made changes, made updates, and she is a master at this. So I'm just so curious. For ladies, Journey to Wealth ladies, let me know. Is this all coming back to you? Like, oh, this is old hat, or like, oh, it's a good reminder. Okay, I think some people said it. Okay, so yes. So the answer is index funds, funds that track the index, are passive. They are considered passive because all they do is take the 500 stocks that are in the S&P 500 in the same proportion, and they put them in the fund, and there's no hot shot fund manager there who is picking and choosing and buying and selling. It's passive. Not a whole lot of action going on. It's just tracking the index. That's called a passive fund. Anybody not understand that? Okay, now I'm going to talk about what an active fund is. An active fund has a hot shot portfolio manager. A lot of hedge funds are like, they're, you know, they got hot shots, some of the brightest and smartest folks, and they are not putting all of the stocks that are just sitting in the S&P 500. They're choosing stocks. And they're buying and selling within that portfolio. So a couple of things about this. Because the passive fund, there's not a lot of buying and selling and trading, the fees are low. The fees for the portfolio manager are low. And also the fees for the fund are low, because every time you sell something and buy something, you have a transaction fee. You can have a profit and loss, and a profit and loss is actually a taxable event. And so it could accumulate a lot of taxes. So you can have a mutual fund that's actively managed, that at the end of the year is operating at a terrible loss, and you still owe a ton of taxes on it because all of the buying and selling generated capital gains. So, I mean, that's another level, but it's just to let you know that actively managed funds are managed actively, and you're paying that fund manager for doing that, and you can also be paying a lot of fees because of the transactions. Now, many what they call sector funds, this is important to know. So let's say you want to invest in healthcare or biotech, and you don't quite know which companies to go with. And we're going to do this more in a boot camp too. What you can do is buy a healthcare fund, a biotech fund, and they usually are more actively managed. So that is a world of passive and active funds. What is the difference between a mutual fund and an ETF? Somebody type it in the chat. I don't see anything coming in this chat. That's why you can't answer. You the ringer. Oh, here I see it. It's the baby. Somebody said. No. Okay. So mutual funds are actually, again, it has a number of different stocks in the portfolio. And at the end of the day, what happens is everything that was bought or sold is added together. You get an average and you understand what the net asset value, what the price is of that mutual fund with all of the different stocks in it. Many people are saying because of technology. So before, you had to do that at the end of the day, and you can only sell a mutual fund once. At the end of the day, once the net asset value was calculated. But now ETFs are mutual funds. They are a mutual fund. They're an exchange traded fund. They are a mutual fund that you can trade like a stock. So all throughout the day, and because of technological advancement, at any moment and point in time, you can do the calculations to figure out what it's worth any moment and point in time. So now you can trade it like you can a stock. So ETFs are a great option. If you wanted to own the S&P 500, you can pay $200. I'm not even sure if it's still $200 right now. You get an ETF, and the most common one is SPY that tracks the S&P 500, and buy that. And when you buy that, you own all of the 500 stocks, a piece of all of the 500 stocks in the S&P 500 just by buying that one ETF. So they're a great way to diversify your portfolio. Okay, so I am going to stop for a moment, and the educator in me is going to make sure that everybody is following along with me. So, passive fund. Oh, I'm going to ask a question. Could there be such a thing as a passive ETF? Yes or no? I want everybody typing in the chat. Yes or no? Can there be such a thing as an active ETF? Okay. So would an ETF that tracks the S&P 500 and has only the stock in that ETF that is in the S&P 500, the 500 stocks in the S&P 500? If an ETF had that configuration, would it be a passive ETF? So come on, ladies. It's so funny because guys, they only understand something 30%. And they're like, I got this. I got it. We got to understand it 99% before we say we got it. And we usually get it much faster too. We just don't like to say that we've got it much faster. So yes or no? Yes or no? Yes. Yes. So remember, an ETF it's nothing, it's a mutual fund. It's just one that trades like a stock. So you can have a passive mutual fund and you can have a passive ETF. And both of them are just tracking an index. You can also have an active ETF. I love some of the tech active ETFs. So I do a stock study program where I show people how to invest in ETFs, and there's a site, ETF DB, where there's some great tech ETFs that are actively managed. Okay. All right. Let me do a check-in. How you feeling about the information that's being shared today? What is that? What's your self-talk give me some, type in the chat, because I really need to pull this out. I really need to know what goes on in women in the ladies' minds when we're going over, there's a lot of information in a short time that we are covering here. Ah, love it. Mm. Yes. All right, keep on typing in that chat. I'm gonna keep going. Okay. All right. Why this is so important. So here we have index funds, which are passive, versus mutual funds. With the and you know what? Some mutual funds could be active and passive. This should really say active versus passive. So US equity markets on the left-hand side, look at this chart. The blue line is funds that track the S&P 500. The orange line is funds that are actively managed. It has been said that passive funds that just do nothing but track the market beat 80% of them beat actively traded funds. So all of these hotshot portfolio managers can't consistently perform as well as the market. So Warren Buffett is a huge index fund advocate. I understand, because I work with women. I'm like, if your money was just in the index fund, you'd be doing great. And so he says when he's gone, he's going to leave his money in index funds. But he also he put a challenge out there to all of the hedge funds. And hedge funds are known for serving the uber wealthy. You have to have a certain amount of money to get in, and they hire the best and the brightest. And he said, I bet you I could beat the performance of any hedge fund by investing in index funds. And one company took him on, and it went on for a few years, and actually the index funds beat out hedge funds. So this is, I'm saying this to you so you'll know that you have a powerful tool right here, an index fund that you can buy, and it'll be low expenses, and it does well over time, that you have access to. But many of us don't know that. So we go for what we think is safe options, and we lose out on hundreds of thousands of dollars. So let's look at what happens with these actively managed funds. Now, remember, they have higher fees because someone is actively managing them. The blue line here is showing the performance of funds tracking the S&P 500. And if you look at these same funds and you add the cost of fees, they perform almost half as well if you add the fees as an index fund. Okay. All right. So where to invest? Many of our 401ks are usually in mutual funds, and you can choose either an index fund or actively managed fund. On Saturday morning, I worked for a university for many years. I had TIAA-CREF. It was excellent. They gave me so many options. I'm going to show you step by step how you can evaluate if you have a retirement account, the performance and benchmarks and the return of your funds. But very often it pains me, for all of the years I've been doing this, even when I worked and the people around me, I was like the go-to person for my department, for departments next to me, for women to come and talk to me about what they should be doing. Although they could talk to the TIAA-CREF, I was the go-to person. And so you can actually, this is how you can invest in funds in your retirement package. Some retirement programs now have ETFs. Okay. Some large mutual fund companies that a lot of our retirement accounts are in are the Fidelity and Vanguard, who both have incredible funds. I'm not as familiar with Schwab. And so right in your retirement account in these large mutual fund companies, you can actually set up a systematic investment plan, which is the same thing as dollar cost averaging, where you're investing an amount over time. And what I tell people, we can't sit on the sidelines. We need to do it, and we need to do it now. I don't care if it's $25 a month. The first thing is to clean up your current investments, to really do an assessment of where they stand. And we're going to talk more about this in the working session. Then there's something called robo-advisors. Ellevest is a robo-advisor that focuses very much on women. The fact that we live longer, we go out of the workforce to raise our kids. We have different circumstances that drive how much money we need to be investing. And they do a great job at it. They have great education. They changed their fee structure a little bit, and they have to like do a deep dive, but you guys can do that. Now you have the information. And the robo-advisors, Ellevest, Betterment, Wealthfront, they all use computer algorithms to manage your portfolio. They ask you a ton of questions, and they invest exclusively in index funds, and they invest, and you can start with any amount, and you can even set up a traditional IRA or a Roth IRA. I've had so many women. I need to have an affiliate relationship with Ellevest because they've just done such a good job for so many women. And if you really, there are different levels. Sometimes you really want to, you're like, I want to be active. I want to have my ETFs. I want to have my sector funds. I want to invest in stock and crypto. You're like, you have the heart for, I want to spend my time on this. And sometimes you don't. You have such other busy responsibilities. I find robo-advisors are great if you, it's a low-hanging fruit, a great way to get introduced to great investments and not having to spend a whole lot of time, but you still should pay attention. Okay. And then there's online brokers. I got to take Robinhood off of here. I no longer recommend them. There's the TD Ameritrades and the Schwabs and the E-Trade. And this is for self-directed investors. And, women who get involved in Journey to Wealth community, it's a community. You have to do the boot camp to be a part of the community. Have seen incredible things happen by really paying just a little more attention, and then a lot more attention to investing and investments. Change your life, to change the trajectory of your children's lives and what's possible and available to you. So these are some of the places to invest in index funds and ETFs. So the robo-advisors almost exclusively use ETFs. The large mutual fund companies use ETFs and mutual funds. And the online brokers mostly just use ETFs because they're, for trading like stocks, and you can trade an ETF like a stock. Okay. So I have to include this in this presentation because of where things are in the economy and the level of instability. For those of you who are interested in investing in precious metal, because they are a store of value when fiat and dollars are unstable, and there are 2 online precious metal dealers that are highly respected and regarded. One is SD Bullions, and the other is JM Bullions. Okay, and so this is for educational. You can do your own research. You may want to use other companies, but these are 2 that are very, have been vetted by a lot of people on Wall Street and different places invest with them. And so I just clicked on SD Bullion, and they'll tell you what the price of gold is right now per ounce, what the price of silver is. They're both up right now too, of course, because the market's going crazy. And then you can buy coins, you can just buy the ounce or bars or blocks or, but this is a resource where you can go to and own some precious metals. And I just feel like not having any precious metals, physical ones, in terms of having a full built out diversification, precious metals should be considered a part of diversification. Gold, of course, has incredible value everywhere in the world. And then silver has value, but it also has utility, and it can be broken down into small denominations. So if you ever wanted to trade with it or buy things with it, silver, the smaller denominations and the value and the lower value makes it easier to trade with, and it has utility because it can be used, you know, in manufacturing and all kinds of things. So those are just, you know, two different pluses and minuses around precious metals. Okay. All right. So assessing your current investments, what you can do, and I'm going to walk you guys through this, but if you wanted to, I'm going to provide a worksheet for you to get started doing this. You can actually go to morningstar.com and you can look for the current expenses, which are the fees, year-to-date return, 1-year return, 3-year return, and 5-year return for the S&P 500. That'll be your benchmark. You want to put that there. This is just an example that I leave there. Then you can list all of the different mutual funds or ETFs that you currently have. This has been jarring. I've been doing this a long time. When women actually look at this, sometimes you have a financial advisor you've been working with, or man that you've been working with forever. Now you have to confront them about what they're, and that has been a challenge for some women about what the fees are. It's like, it's been an opportunity for some women who've been like, why do you have me paying these fees and these, when I could be in a mutual, index fund. And, you know, some women just like, some really strong women just back down and like, they know that they're not, their fees are too high and they're not meeting the benchmarks. And so this is the work of it, is to actually look at how your assets are performing and make some decisions around it and make it a priority. Okay, so you're going to receive more information about how to do this. Okay, you're going to check the market, the SPY. You're going to check the overall performance of your portfolio too, and then check the fees, and you'll enter that. And we're going to go over this in the working session. But I find like I like to go over it with women. I like to show you the process in the working session, and step you through that. Okay, so this is a testimonial, and this is a woman in our community. She was in her late 60s to early 70s. And she really took it on. At one point in time, she used to even help with the working sessions. And I really want to read this to you so you can understand the power of this. Okay. Let me move this out the way. Okay, so she said for the last couple of 5 years, her 401 quarterly earnings have been minimal. In fact, one changed management at least 3 times in the last 4 years, and each year they swapped them out in the same low performing assets. Each time I've allowed the management company to make the allocation, because while I have investment accounts, I know nothing about investment, and it's a brilliant woman too. I did not realize just how it affected my earnings until I took the Journey to Wealth workshop. The truth is, when the quarterly statements arrived, I barely took a look and actually thought that I was doing good because I just wasn't losing money. It never crossed my mind that there must be better securities or that I was leaving money on the table. After the workshop, and I'm summarizing, she researched each security in her portfolio. She used Morningstar.com. She Googled each asset management company. She identified a security that matched the criteria I'm talking about in terms of benchmarks. She looks for ETFs and index funds with low expenses and holdings in major companies. She looked at the performance over the 5 years and returns. And it took all evening. She did it after a session on a Thursday evening. She did things all day Friday, and by the time Saturday morning had rolled around, she was fully engaged. And she vetted them and went to EFT.db, is something I teach in the boot camp, and went to bed. The next morning, she called the first asset management company, told the associate what she wanted to do. She was prepared for a fight, and was surprised when they only chuckled and said, "Oh, you're taking a bigger risk." And they meant it to be snarky, but it was true. And I finally had the information I needed to take a calculated risk. If I had $1 for every woman who's ever worked with me, particularly during COVID, when I had a captive audience and I worked with over 1,000 women who said, "Oh my God, I finally have the information to actually look at my portfolio and make different choices and not just being something getting 2 to 3%. The rest of the day was spent researching, applying the same criteria for her other 401ks. That time it didn't go as smoothly. She received confirmation email about the changes. They put in wrong securities, wrong percentages. 2 emails and 2 calls later, she confirmed the reallocation. 2 months later, she called to get an update on how her portfolio had changed. In only 2 months, one had earned 7 times the quarterly earnings, and the other had earned 5 times the quarterly earnings. And then she said, "Happy dance." So this is the kind of, it's doing the work, though. It really is taking the time to do the work. And I mentioned that Swati took the work, did the work. Now she was in retirement doing this. Okay. So the last thing I want to talk about is investing in technology. Because in technology, you get accelerated returns. You double your money in incredible ways, and it's an area that women don't play in. There are 2 time-tested ways to accelerate your wealth and build wealth quickly and for generations to come. What's the other way? Innovation testing, and everybody usually knows the other way immediately. It's the other way we build wealth, ladies. Real estate. Real estate and tech. Accelerated wealth. You're doubling your money quickly. So usually you either have FOMO or phobia when it comes to crypto. We're going to talk about crypto because that's the technology, the future of money, about the future of jobs, the future of money. How many of you got FOMO, fear of missing out? Electronic hands, yes. Or wave your hands. How about fear of being in? How about both? I see both hands going up. I don't want to miss out, but I'm afraid to be in too. And the way you deal with this is really understanding education. So I'm going to talk about it for a second. So the blockchain is the technology that these currencies sit on. And what I like to say is that the blockchain will do for transacting what the internet did for communication. All the internet did was allow computers to talk to each other and then to transfer information between each other. But we know how it changed our lives. The blockchain allows peer-to-peer transaction through distributed ledgers, multiple ledgers across a network of computers without the need for a central authority. The integrity of the content of the distributed ledger does not rely on individuals or organizations, but on the underlying software technology, which is cryptography. So what I want to say to you here, I know we have a short time. I talked to you about the fact that currency and storing value. Banks and governments make decisions that can destabilize currencies. An alternative to currency, something that has a universal value, we talked about, was precious metals, specifically gold. Bitcoin is considered what they call digital gold. It is an alternative currency that sits on the blockchain that has value and is a store of value and does not rely on government or banks to set the value. Now, I'm going through this quickly. So currently, the government decisions, Argentina, the US now, overridden with debt, doing it in cycles, and it only compounds it. Monetary policy, like raising interest rates 8 times in a short amount of time, pretty much rendering all previous treasury bills that issued, devaluing them. And to understand that, and I'm going to try to do this as quickly and succinctly, when the Fed raised the interest rate so high, they're selling treasury bonds. The new treasury bonds have a much higher interest rate. So that's all people want to buy for long-term bonds. So that means the old ones, what happens to them? Nobody wants to buy them, so they cost less. So only banks, like we see the collapse of the banks, they invested in long-term treasury bonds when they didn't have to. They could have done short-term treasury bond. And now they're worth less than the original deposits that people gave. So you see the government monetary policy raising interest rates so quickly, the banks investing in long-term investment to cover short-term deposits. So you see decisions being made that can cause financial instability. And your currency, the money that you're working for in your pocket and you have in the bank, is at the mercy of these decisions. And so the reason why people have the goals in the vaults and are investing in things like cryptocurrency is because it gives you other options. Now, I'm giving you a quick and dirty around this, but it is actually revolutionary. And instead of having to trust institutions that for centuries have literally have human beings making decisions that sometimes are off of greed, sometimes a mismanagement, all those things, let's create a currency that sits on a technology that we do not have to trust centralized organizations. It's powerful. So the blockchain, whether people question cryptocurrency at this point, it is fully integrated. The blockchain technology is the technology of the future. To be able to do peer-to-peer without central authorities and having all of the concerns. And let's talk about what that looks like. So first with crypto, Mastercard and Visa said, can't beat them, join them. They're like, this is actually expanded. This is 2021. I have the new ones. I don't know why the old ones are here. There's a crypto index now with the S&P 500. You have Morgan Stanley saying cryptocurrencies are here to stay as a serious asset class, and Bitcoin is making progress to replace the dollar. This is what Morgan Stanley is saying. We have Fidelity saying that that is now helping this institutional investors. Those are the investors that make the big purchases that move markets, store and trade Bitcoin since early 2019. Fidelity Digital Asset has, well, it was 100 clients, it's much more now. And it allows individuals to hold Bitcoin in their retirement accounts. And they have Fidelity file paperwork for a Bitcoin index fund. So it is clearly the adoption of it as an asset class. And I have a video, there's a movie called, I gotta think, it's on Netflix. And it shows every single, from Jamie Dimon, they're all like, oh no, of course, 5% of my portfolio is in Bitcoin, of course. They're all mass adoption. And then I want to talk about the blockchain and the peer-to-peer and the fact that it eliminates the fees and you can transact. Right now, governments want to capitalize on the technology that powers cryptocurrency and investing in their own digital currency. It's here. China has one. It's called ECNY, They released it in 16 provinces. Now, the thing about cryptocurrency and this, it's programmable money. So they said you got to spend it by a certain date, all kinds of things. 114 countries representing 95% of the global GDP are all exploring and moving forward with central bank digital currencies. The future of money is crypto. So, and even Joe Biden issued an executive order to catch up and make sure it's deemed a matter of natural interest. So this is programmable money. I just want to say to you that these central bank, because it's supposed to be decentralized currencies, remember who has some kind of sovereignty outside of the banking system and the government system. It's currencies that are not, it's gold. And now Bitcoin, let's just talk about that, is an alternative as we're moving towards central bank digital currency. Those who own Bitcoin will have a digital currency that is not under the banks or government direct control in that way. So this is why it's being called digital gold. It is here. We're moving forward the world. So the banking system, now in the banking system, they get fees every transaction between banks, they get high fees. And then the international business to business, I can talk so much about the SWIFT system and how it could take between 1 and 5 days and unpredictable fees. And it's keeping whole countries, particularly Africa and Asia, out of the game because they have to go through the SWIFT system. So now the adoption of CBDCs could eliminate billions in fees, and banks, and we already talked about governments, are going to their own forms of cryptocurrency, money sitting on a blockchain that's programmable. So it's important. So ladies, I didn't say this in the beginning. One of my passions about doing this is I feel deeply that if women don't understand markets and economies, monetary policy, technology, that none of the changes we want to have happen in the world are going to happen. So it's important. We can't just, we receive so much social conditioning to say we can't do this, we got to stay out of the game. But we can't afford to for so many reasons. We also want to be shaping this, and you got to understand it to shape it, but in our own lives. And for the women, the young women who are coming up underneath us, to understand the importance of being a player in these games while they're being developed. We're in the beginning of the 5th industrial revolution. And now is the time where wealth is built in the beginning of these revolutions. Every other revolution, we were all cut out. A woman couldn't even have a bank account until 1960s. No, we were not playing in the Industrial Revolution. There are no barriers to entry. There's nothing to stop us from doing it now. All right, so what do? We take action. We do it scared, we do it uncomfortable. And in the session on Saturday, I'm gonna go over assessing your portfolio, your current investments. And I'm also gonna go over how you purchase cryptocurrency, just a brief introduction to it. Okay. All right. So take action. Complete your assessment portfolio analysis form. You can look at it and take a shot at it. Zwadi, can you drop the form in the chat? I'm going to send it to you also, but it's also you can drop it in the chat. I highly recommend that there's a clickable link that you add it to Google Drive, so it's on your drive, not on your computer in Excel, not on your Mac and numbers, but we want to, the next level is you want to have it, make sure you upload it on your drive and that you, so that you can share it and have access to it in a different way, okay? All right, so add it to Google Drive, follow the instructions and complete it. I'm gonna have an additional instruction form, but we're gonna go over it on Saturday. Attend the working session on Saturday from 9 to 10. Okay, and then the Journey to Wealth Bootcamp is a month-long program I go into a little more depth. I require you to do some of your, the real program happens in the work that you're doing between the sessions, but it's a complete roadmap to building wealth, from net worth, to managing your money, to being masterful at it. We do spending fast, heal your relationship with money, journaling, gratitude, journaling, and we really work on do the inner work and the tactics to really and truly be in the wealth building game. And then invite friends and family to the boot camp, and invite them to future master classes, because this year is important and we really need to know and learn. Share this information, have conversations around it. But while the market is down, and while the market is down, and we don't know what's going to happen over the next couple of weeks as more and more banks start to disclose the financial position that they're in. And you now have the information to see it as an opportunity. So what there is to do now is to clean up the stuff, your account, and look at your current allocations. That's the accumulation. If you're still working and you're making contributions, it's real important to update those. Put them in the right places while the market is down. And then it is important at times like this to have a certain cash position for an emergency fund, and also to take advantage of opportunities. So there are smart decisions, and I'm going to do the tips and stuff to do now when we meet on Friday. I will have the Ask Me Anything session on Monday from noon to 1 p.m. And you're welcome to invite friends and family. Please follow me if you have not done so on Journey to Wealth at Women in Action on Instagram. Please follow me on Instagram. And I'm going to stop here. And I'm willing to stay on for, but first, if everyone in the session could take 2 minutes to type into the chat your reflections on what you learned today. And I see some hands up. You can absolutely ask questions now. I'll stay on for 10 minutes. And but please, I really need to hear from you on your reflections from the information that was covered today. Okay, Pam, you had a question? Is that from last time? Your hand is up. Okay. If anyone has questions?
Alicia, I did want to say, this is Gina. I wanted to say that, the document we need permission to open the document, the Google Doc.
Okay, let me make sure I give you that.
Okay. But I'm just really, really excited to keep going. This is very helpful. Of course, you're an excellent teacher. This is really, really helpful. And so I'm just excited. I just want to share that. Thank you.
Good, okay, you are welcome. Thank you. It's why I do what I do. Anybody, share if you're not excited, if you're like, oh my God, this feels overwhelming. I want to hear it all. I'm gonna call on some folks. I'm gonna call on some new people. I see some, let me look. Misty, you're right here.
So I'm actually typing part of this. I have learned the terminology. when you were in the Dare to Challenge yesterday with Jolie, it was like, oh my God, I need this woman. So I didn't understand the terminology, and I did have all these things coming to my emails in the morning of all this big talk that didn't break it down for me, and I didn't understand it, so I wasn't reading them. So not only the terminology, but what they mean. So I have a little bit better of a grip on it. So I want to maybe start investing, but I wouldn't have known where to start. I didn't know the EFTs. I didn't know that you could do little amounts. In my mind, I thought you could do big amounts. and who has big amounts. You know? So yes, I've learned a lot. I'm not gonna lie, it's a little overwhelming. And like when you brought up the crypto, it's like, but didn't some guy just lose a bunch of money from people, or some people lost that money from the guy that got in trouble? It's like that is risky to me. Just because you watch that on TV, you're like, oh.
Yeah,
So-
I have a whole slide around TV and fear mongering. Someone put that in there. Banks lose money every day. There's all kind of bank fraud every day, but there are things that you need to do to secure your crypto, and there are huge opportunities. And it's a new technology, so it is going to be a little riskier, which is why a lot of people do 2% of their portfolio. But as women, we just can't afford to be on the sideline and not to be in the game at all. And I know this is a lot of information that I shared today. And on Saturday, we're going to talk about what are some small steps and small wins. And then I also have the boot camp where we really create community and work and support each other. And thank you for that, Misty. Cynthia. Mm-hmm.
I too was overwhelmed at first, but just listening to you, it just made me want to get on my computer and start assessing where I'm at, especially now that I have more control over my 401k. And it was like, at first I looked at it, I had someone talk me through it, but whatever he said just went right over my head. And this is so much more simpler. It's still a little overwhelming because you feel like, should I or shouldn't I? But when you're talking, it makes it feel like I could go right on my computer right now and at least try. And you know, come what may, there's support here to say, you know what, you got to get in there. Even small steps are steps. So.
Absolutely. And,
Yeah.
and taking those small steps and celebrating our small wins, even if you just look at and say, okay, I'm gonna look up two things that I have in my portfolio, like what are the expenses and how much is my return? You know, absolutely. And now, and know it. And the more you hear it, it's good to you know, in the Seducing Abundant Challenge, I went over some of this, like a 20-minute version. And now we have an hour version. And in the boot camp, we go deep. You have daily things you do and how what you do. And you know, women who've been in the community for some time, there are quite a few ladies on here I'll share. Like literally, it can change your life and you become very, very empowered. Cassandra, you're right, dead center in the middle. And you can share, but before you do, and we're gonna have positive affirmation when you share, Cassandra. I'm gonna well, go ahead and share, Cassandra.
Can you hear me?
Yes. Mm-hmm.
I just want to say that Misty and the other woman, Cynthia, I think it was, I was there. I was there. I was there with total overwhelm. And I wanted to say that I was a person who, I didn't even check my bank account. I was so intimidated by money. All I knew was that I had enough money to pay my rent. I lived from fear. I came from fear. The first time I learned about arithmetic, it was fear, fear, fear. And I can't believe the transformation. Now, and I just want to say, it's taken me, I was patient, to be patient with myself. I've been in the community, and what I was taught by the wonderful Alicia 2 years ago, I'm beginning to, you know, I'm now, but I had to be patient. In many times in the community, I felt myself behind. I had to go back over the classes, back over the tapes, over and over again, slowly understanding, you know, from the ETFs, the candlesticks, the wicks, all of these things. Just be patient with yourself because you can get it. And I have a portfolio. I have a portfolio and I am 73 years old. So let me just
She has
say,
all the portfolios. Her retirement account. I mean, she did all the work. The crypto, all of it.
Yeah,
I mean,
yeah.
she has multiple portfolios, and she's. I know you're like, but just own the work that you
Yeah,
have
yeah,
done over
yeah,
time,
yeah,
and where
yeah.
you are right now. Cassandra is amazing. All right,
And I
see
just want
that.
to say one more thing. My family, so many people around me are afraid. And so many older people around me are afraid. And don't even mention crypto. Okay. While the world has changed into digital, whether you like it or not. So I just want to, yeah. Thank you, Alicia. Thank you.
Oh, welcome. Thank you, Cassandra. You do the work. Gina, did you have a question?
When you showed us the platform for gold, so is that gold, if we buy gold on that platform, is it on the stock market, or is it just on that platform, or is it, and
Oh, you're buying physical products there.
oh,
You
it's
gotta
a
have some.
physical, okay.
Yeah, so having some physical gold, because
Mhm.
there are, I teach people the ETFs, exchange traded funds, and the gold mutual funds and stuff. But that's different than when, the people in Argentina, when their markets collapse and their money collapse, the folks who have physical gold were the one, and physical silver were the ones who were safe. And I just want the importance of me showing you that vault is to show you that the uber wealthy, they know how important it is. They stack it up because they know when stuff gets real shaky, the few things that hold value that you usually can change and exchange is some precious metals. Yeah.
Okay, thank you.
You are welcome. I thought I saw another hand up, but it just moved. Tasha, how are you? Oh, you're on mute. We can't hear you.
Oh, okay. Can you hear me now?
I can hear you now.
Okay, great. Okay, great. So I'm so glad I was able to participate tonight. But tagging on to the question that was just asked about gold, and when you purchase it, yes, you're getting physical gold. But when the website talks about, offering it at a particular price compared to, there's a certain phrase they've been using. Is it about me, the consumer, going out and figuring out what that phrasing means to understand if the amount that you're purchasing it at is actually a good deal or not? Do you have any clue what I'm talking about? Because I don't remember
Yes,
the
I
exact
do.
phrasing, but when you look on that website, they talk about, they're offering at whatever the pricing is, right? And it's like, well, is that really a good price or
Yeah. So now
or
the thing,
not?
so the thing about it now, of course, anybody who's selling anything, they're gonna make their money on it, so they charge a little more.
That makes sense.
So,
Yeah.
yeah. So so they even have stuff that they have deals. I like to look at what deals that they have.
Yeah,
And
over spot. When it talks about that spot pricing. Yes, yes. Go ahead. I'm sorry. I apologize. Go ahead.
so there's a spot price. There's a price per ounce that we know it is all over the world. And then there's a price they sell it for. And so, and what they usually do is they charge you, if you order a little, you're gonna pay the premium on the fees to purchase it. But if you buy a lot, then the fees that you pay to purchase it are a lot lower. And then there is some stuff about the quality of, particularly with, silver, where it's not pure, they may have some residual stuff and things like that in. And then there's I can never say, pneumatics, I think it's called, with coins that and things that have value that have nothing to do with just the spot price. Look, gold is going up in front of our eyes. Had nothing to do with, yeah, I'm sharing my screen. Nothing to do with the spot price, but it has to do with all other kinds of things for collectible that create values. But so yeah, so what you want to do is make sure, like, if you see the spot price of silver is $23 and 33, and you're new to this and you don't know all of the collectible stuff, you want to just look at how much more you're paying over the spot, over the actual price that it is all over.
Okay,
you
so to say the spot is meaning to say the actual pricing that's displayed right there on our screen, on your screen. That's
Yeah,
that's what the spot means.
yes, yes. Mhm.
Okay, thank you.
And I'm glad you asked. Okay, so thank you, ladies. I know if you're brand new to this, you need to hear it a couple of times. I just know it. I'm gonna have it Ask Me Anything on Monday. We'll be here again on Saturday morning. I'll be a little late. I'm gonna do the hour session. I'm gonna run over to, it's not far, to the 500 men brunch. If anybody's in the city, it literally could be like a great networking experience, jam-packed with information and meeting great people if you guys come. All right. Well, thank you, thank you, thank you, thank you. I will see you on Saturday morning. I'm just looking at Melissa. I just want to do a check-in with you. I'm looking at your face. I'm like, let me check in with Melissa. How's she doing? Because you were, I saw your face on every single.
I am super excited. I'm sitting here going on Bloomberg. I got my 50-30-20 going on. I got numbers everywhere. And I think I'm going to make a pot of coffee and get cracking. So I'll be up
Love
late
it.
tonight.
Love it, love it, love it. All right, ladies, I'll see you on Saturday morning. Take care.